Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Lucid Group.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description.
Yeah, it's a really great platform.
It is. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news.
Right, but the pro tier is where it really opens up.
Exactly. But if you want deeper research, stockanalysis.com Pro gives you no ads, saved screeners, watch list portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets.
Which saves so much time, honestly.
Oh, massive time saver. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list and comes down to about $14.93 per month when billed annually after the discount.
That's incredibly reasonable for what you get.
It really is. Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Okay, so I want you to imagine for a second that you are investing in a massive, state-of-the-art luxury hotel.
Okay.
But it's right in the middle of a desert. The blueprints are flawless. The partners building it are world-class. There was just one massive problem.
No roads to get there.
Exactly. The highway to get to this hotel won't be built for another 2 years. You have to place your bet today, knowing full well the construction company has to survive 24 months of burning through cash with 0 guests.
Wow. Yeah, that's a stressful bet.
Right. And that jarring scenario is exactly the multi-billion-dollar gamble happening right now with Lucid. If you glance at the headlines, you literally just see the desert. You see missed expectations and just a lot of anxiety about electric vehicle demand slowing down across the board.
It is definitely happening.
Yeah, but if you look closely at how institutional capital is actually moving, smart money is completely ignoring that near-term friction. They're looking at the highway being built.
They absolutely are. And it's because, the entire identity of this company is undergoing a radical shift right now. This is no longer a story about a boutique, struggling automaker trying to sell low-volume, ultra-luxury sedans to early adopters.
Right. It's bigger than that now.
Much bigger. The narrative being priced in right now is a complete reimagining of the business model. They are pivoting toward becoming a high-volume robotaxi fleet provider.
All right, let's move into the wealth building context, because this is huge.
It is. When you evaluate a transition of this magnitude through the lens of long-term portfolio growth, you really have to frame this as a deeply asymmetric recovery trade.
Let me stop you there for a second,
Yeah.
because asymmetric is a word Wall Street loves to throw around to sound smart.
True.
For anyone listening, an asymmetric trade just means the potential upside wildly outpaces the potential downside. Like you risk $1 to potentially make 10, but the caveat is, you can still absolutely lose that $1.
Precisely. And that's why this is absolutely not a quick swing trade. If you are a trader looking to get in and out in 3 weeks based on a chart pattern, this setup is going to chew you up and spit you out.
Yeah, it's way too volatile for that.
Exactly. Capturing the real value here requires a multi-year mindset. You are specifically aligning your investment horizon with the massive robotaxi production ramp that is scheduled for 2027. You have to look past the current turbulence.
The noise, the missed deliveries, all of that.
Right, and focus purely on the sheer scale of the recurring revenue potential that comes with fleet economics. Selling one car to one person is a tough, low-margin grind. Deploying 10,000 autonomous vehicles that run 24/7 and generate high-frequency fare revenue, that alters the entire demand curve for the business.
I have to push back a little on just writing off the current turbulence, though.
Okay, fair.
Because long-term wealth building requires that your capital actually survives the short-term pain. The vision of a 2027 robotaxi utopia is incredible, yes. But going back to that luxury hotel analogy, you have to be absolutely sure the company won't go bankrupt before the first autonomous guests can even take a ride.
That's the real risk.
Yeah, because the market might be looking past current EV demand friction, but the company still has to pay the bills today, next month, and next year while waiting for that highway to open.
That is the ultimate tension right now. But that survival instinct is exactly why institutional money is positioning themselves where they are. The smart money knows the highway's being built, and they know who is funding the construction.
Now let's look at the fundamentals. Because if we want to know if they can survive until that highway is built, we have to look under the hood at the financial health and the actual business model as it stands in reality today.
Right.
And recently, reality delivered a Q1 2026 revenue miss. That's a fact.
It is a fact. But viewing a single quarterly miss in a vacuum is how retail investors get shaken out of structural transitions. If you zoom out just slightly and look at the 2025 10K.
Hold up. Just for those who don't spend their weekends reading SEC filings, the 10K is the massive annual report a company is legally required to file. It gives you the full, unvarnished year in review. So what did that actually show us?
It showed us continued sequential revenue growth, meaning quarter over quarter, the underlying revenue base was expanding. And that growth was driven directly by the initial rollout of their Gravity SUV.
Oh, okay.
Yeah, so the consumer demand for their new, larger form factor is verifiably there. The recent revenue miss is much more reflective of broader macro-level sector friction like high interest rates making car loans expensive, rather than a fundamental failure of their newest product line.
Okay, I'll grant you the top-line revenue growth. But we desperately need to talk about the margins.
Yeah.
This company has historically suffered from deeply negative gross margins.
Yeah, they have.
And again, just to clarify for the listener, gross margin is the most basic metric of survival for a manufacturer. If it costs you $100,000 in raw materials and labor to build a car, and you sell it for $80,000, you have negative gross margins. You are literally bleeding cash with every unit that rolls off the assembly line.
It's painful to watch.
Extremely. They've been hammered by low manufacturing volume combined with incredibly high input costs.
You're completely right. When you aren't producing at scale, every single vehicle costs a fortune to build. But the most recent 10Q, the quarterly financial update, highlights exactly how management is surgically attacking that exact problem.
What are they doing?
They are aggressively implementing cost-cutting measures and focusing heavily on supply chain localization. They are trying to source parts closer to the factory to drastically reduce the per-unit bill of materials.
So tightening up the logistics.
Exactly. Yes, margins look terrible in the short term. But this entire pivot to fleet economics is designed to finally leverage their massive fixed manufacturing footprint. If they can reach fleet scale, there is a very credible, mathematically sound pathway toward gross margin break-even by late 2027.
Let's talk about the balance sheet, because that is where the intense debate really lives.
Yeah.
As of that same quarterly report, they have over $1.5 billion in cash and equivalents.
Which is a solid cushion.
It sounds like it, right? To a normal person, $1.5 billion sounds like an infinite amount of money. But we are looking at a heavy, heavy cash burn rate. They have deeply negative free cash flow. And it's crucial to understand where that cash is going.
It's definitely not going to dividends.
No, definitely not. It isn't being returned to you as an investor in the form of stock buybacks either. It is being aggressively shoveled into an absolute furnace of advanced manufacturing networks and autonomous R&D.
It is a furnace. But this is where their two massive structural moats come into play. The burn rate is undeniably high, but it is deeply protected.
How so?
Well, first, you have their technological intellectual property. They possess industry-leading powertrain efficiency. Their in-house drive units achieve the absolute highest kilowatt-hour per mile efficiency in the entire electric vehicle sector.
Okay, but why does that actually matter? If I'm buying a luxury sedan, I might care about range. But why is that specific metric the holy grail for a robotaxi fleet?
Because in a high-mileage commercial fleet operation, energy consumption directly dictates your profit margins. Think about it. If your autonomous vehicle can go 20% further on the exact same amount of battery power as a competitor, your vehicle spends significantly less time plugged into a charger and significantly more time out on the road generating fares. Over the lifespan of 1 million miles, the economics of a fleet live and die on that baseline efficiency.
Oh, wow. That makes total sense. The operational overhead shrinks massively at scale.
Exactly. And the second moat is their capital structure. They have the sovereign wealth backing of the PIF, the Public Investment Fund of Saudi Arabia.
Right, the PIF.
Yeah, and That is a capital moat that is almost impossible to comprehend. It allows them to survive macro demand cycles that would instantly crush a normal startup. The valley of death between having a great prototype and reaching mass production is where most car companies go bankrupt.
Because they just run out of money.
Right. Having a sovereign wealth fund essentially guaranteeing your survival gives them a layer of armor that pure-play competitors simply do not have.
That brings us to the catalyst timeline. Because if the fundamentals show a company spending aggressively to build the future, we need to know exactly what events are going to trigger that future. When does the highway actually open?
Yep. The timing is everything.
And to answer that, we have to start with this massive Uber and NVIDIA triangle.
This partnership is the core of the entire investment thesis. We are looking at a $1 trillion self-driving opportunity. Uber is planning a massive, aggressive robo-taxi rollout across 30 major cities in just 2 years.
30 cities in 2 years. That's insanely fast.
It is, and this isn't just a rumor on a message board. NVIDIA CEO Jensen Huang explicitly confirmed the partnership that is powering this autonomous push.
So let me make sure I have the mechanics of this right.
Yeah.
NVIDIA is providing the absolute cutting-edge computational brains, the artificial intelligence.
Yep.
Uber is acting as the nervous system, providing the dispatch network and the endless customer demand, which leaves Lucid to provide what? The skeleton and the muscle?
That is the perfect analogy. Lucid is positioning itself as the high-efficiency physical vessel for NVIDIA and Uber's software brain.
Interesting.
You know, you can have the best autonomous software in the world, but it is useless without a physical body. And that software needs a body that is engineered for maximum energy efficiency so it can stay on the road longer. That is exactly what Lucid offers.
So if I'm looking at my calendar, what are the actual dates I should be sweating over to see if this thesis is intact? Because August 2026 is glaring at me. The Q2 2026 earnings report is going to be a massive catalyst event.
Definitely. And you aren't just looking at the headline revenue number in that report. You want to look specifically for Gravity SUV delivery volumes to ensure their consumer business is stabilizing.
Right.
You want to track the exact R&D spend on the robotaxi platform. And most importantly, you need to look at any CapEx guidance for this Uber fleet build-out.
And just to translate, CapEx is capital expenditure. That is the actual hard cash they're spending to buy physical things like retooling a factory line or buying robotics for the assembly floor. If CapEx is rising, it means they are physically preparing to build the fleet.
Exactly. We also might see a dedicated robotaxi investor day or an autonomy tech showcase soon. When you have partners with the prestige of Uber and NVIDIA, you don't hide it. You want to demonstrate that software and hardware integration publicly to fundamentally shift the Wall Street narrative.
We also need to factor in the macro tailwinds here, specifically the Federal Reserve. When the Fed cuts interest rates, it disproportionately helps long-duration growth stocks like this.
Oh, absolutely.
Let me explain why, because it sounds like financial magic, but it's really just math. If a company is promising you massive cash flows in 2027 and beyond, you have to discount those future dollars to figure out what they're worth in your pocket today.
Right, the time value of money.
Exactly. When interest rates are high, $1 in 2027 might only be worth 80 cents today. But when interest rates drop, that discount rate shrinks. Suddenly, those 2027 cash flows look incredibly valuable right now. Plus, lower rates directly ease the cost of capital. It makes borrowing money to build those factories much, much cheaper.
Now let's pivot to the chart.
Right, because there is a stark, almost violent contrast between these long-term fundamental catalysts we just discussed and the chaotic, immediate price action happening on the screens right now. We are seeing a very volatile, but ultimately constructive bottoming phase.
It's fascinating to watch because despite the recent revenue miss we talked about earlier, the stock didn't collapse. We actually saw sharp, sudden surges in the stock on Wednesday, and it continued rallying straight through Thursday morning.
This is a classic sell the news, buy the rumor, reversal pattern. The market got the bad news on the revenue, they digested it, and instead of panicking, they are actively pricing in the 2027 breakout narrative.
Yeah, they're looking way past the current quarter.
They really are. They are collectively choosing to weigh the future robotaxi potential much heavier than the near-term friction. But we also have to acknowledge there's a mechanical reason for this volatility too, which is short squeeze dynamics.
Yes. Short sellers have been piling into this stock. Broader sector data shows extreme bearish positioning, with some alternative energy and EV stocks sitting at up to 86% short interest.
86%, that's insane. And when you have that much short interest, it acts like literal rocket fuel for the stock price. Think of it like this: Short selling is like borrowing your friend's car, selling it today, and hoping you can buy an identical car next week for half the price to give back to your friend.
Right, and you pocket the difference.
Exactly. But what happens if an autonomous update drops? Say, a surprise press release about the Uber partnership and the price of the stock triples.
Yeah.
Those short sellers start bleeding money instantly. They panic.
They have to cover.
Yeah, they are forced to buy the stock back at the current market price just to cover their positions and stop the bleeding. That panic buying creates a violent, artificial wave of upward pressure. When a stock is heavily shorted, any positive catalyst can trigger severe squeeze dynamics.
So what does market sentiment look like?
If we move away from the raw technical data and look at how Wall Street and the major institutional players are actually behaving, we are seeing some shocking institutional moves.
The biggest and most telling one is Coatue. This is a highly prominent, wildly successful, tech-focused hedge fund.
Yep, they are heavy hitters.
Very heavy. In Q1, they made a massive rotation. They nearly completely exited their Tesla position. They trimmed their NVIDIA stake. And they used that freed up capital to build a brand new position in Lucid alongside Hertz, explicitly labeling it a speculative recovery trade.
Let's not gloss over that, because that is a massive structural vote of confidence. When a Tier 1 fund takes their capital out of the undisputed EV king Tesla and moves it into your struggling startup, that isn't just a portfolio tweak.
No, it's a huge statement.
That is a statement. People notice that.
Yeah.
We also have Citigroup analyst Michael Ward coming out and maintaining a buy rating. He did lower his price target slightly, down to $14, but let's be real, from current trading levels, a $14 target represents massive, massive upside.
Definitely. The institutional models clearly foresee substantial EPS or earnings per share improvement as this production scales up.
And then, of course, you have the rumor mill constantly churning in the background.
Right. And I want to be perfectly clear with you listening. These are unconfirmed market rumors. They are not facts, but they are absolutely driving sentiment right now.
So what's the chatter?
There is active, persistent chatter about Uber potentially doing a partial acquisition of the company just to secure their hardware supply chain for this 30-city rollout. You also have loud rumors that the PIF might just decide to take the company private entirely.
And if you understand the capital requirements, the logic for going private makes perfect sense. If the robotaxi ramp is going to be this intensely capital-heavy, going private eliminates the constant public dilution. It removes the exhausting quarter-to-quarter scrutiny from Wall Street analysts who demand immediate profits.
Yeah, it perfectly highlights how polarized times are right now. The market as a whole is incredibly bullish on the total addressable market of the technology, but they are intensely bearish on the near-term capital structure.
Now let's talk about the risks.
We have to directly address that near-term capital structure because this is where the bear case lives, and it is a very real, very dangerous threat to your portfolio.
The phrase being thrown around by the bears is the dilution machine.
Ouch.
Yeah, it's brutal. That $10 billion Uber robotaxi bet is a beautiful vision, but it requires billions in capital expenditures to actually execute. Pivoting a factory from making boutique, handcrafted luxury cars to pumping out high-volume fleet pods requires tearing things down and building them back up.
Which takes a lot of cash.
Tons of cash. This could easily force the company into ATM offerings. ATM stands for at the market. It's when a company creates new shares out of thin air and sells them directly into the market at current prices to raise cash.
Or they might have to issue convertible notes.
Right. Either way, it's like watering down the soup. It severely punishes existing shareholders by diluting the value of the stock you already own.
It is a painful, unavoidable tax on capital. But the mitigation here, the safety net, is that PIF backstop we mentioned earlier. It ensures the capital is actually available to capture this massive market.
So it's not a desperation move.
Exactly. This isn't a dying company diluting shares just to keep the lights on and survive another month. This is purpose-driven dilution designed to capture a trillion-dollar opportunity. If they execute on the vision, the overall equity value of the company expands more than enough to absorb that temporary dilution.
But that brings up the second major risk, which might be even harder to overcome: execution risk.
Yeah, that's the big one.
Historically, they have missed production targets. It is a known, well-documented issue. And scaling from low-volume luxury to massive fleet economics is a completely different beast. The supply chain hurdles, the quality control at high speeds, it is an enormous operational challenge.
Which is exactly why we just saw a major leadership shuffle at the top. Interim CEO Mark Winterhoff has officially handed leadership over to a veteran executive, Silvio Napoli.
Oh, that's interesting.
Yeah, this isn't a random staffing change. This signals a very clear, deliberate shift away from the visionary conceptual leadership phase directly into a phase focused purely on ruthless operational execution and scaling. They know the manufacturing floor is the bottleneck, and they're bringing in the operational heavyweights to fix it.
So with everything on the table, what's the final verdict?
When you synthesize the massive upside of the catalysts with the very real immediate risks of dilution and execution, the bullish score comes out to a 7 out of 10.
It is a high-risk play. There is no denying that, and you shouldn't pretend otherwise. But it offers a highly asymmetric reward profile. You have sovereign capital providing a financial safety net, and you have Tier 1 tech partnerships with Uber and NVIDIA fundamentally validating the technology.
And that brings us back to the target horizon. We cannot stress this enough. Playing this setup requires a multi-year view. We are talking 18 to 24 months as an absolute minimum hold. You need the patience to get through the near-term dilution and the manufacturing strain so your capital is in position to capture the 2027 robotaxi ramp.
But here's the lingering question you really have to ask yourself. If autonomous fleets actually dominate by 2030, does the brand of the car even matter anymore? Or does the vehicle just become an invisible, commoditized pod that takes you from point A to point B?
That's a profound question.
And if so, is this company's luxury DNA a hidden strength? Or is it going to be entirely irrelevant in an Uber-dominated world?
Definitely something to think about.
If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description.
Highly recommend it.
Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.